Did you know that your Social Security could be taxed? Every year, I have a handful of clients that learn that for the very first time. There's this ongoing assumption that because you paid into Social Security, when it's time to claim it, it's not going to be taxable. There's this ongoing assumption that when you retire, you won't have to pay any taxes because you're retired. Simply not true. In retirement, depending on where you get your income from, some of your income will be taxable, and that taxable income could cause your Social Security income to be taxable. It's Tiffany Gonzalez CPA here, and I'm going to break that down for you. 10 years in this industry, let's talk about it. Up to 85% of your Social Security could be taxable. It all depends on what's called your provisional income. This is a term that is used by the IRS and the Social Security Office in order to determine whether or not your benefits will be taxable. It consists of a few key components. Number one, how much tax-exempt interest income you have. Number two, what is 50% of your Social Security benefits? And number three, are you still receiving wages or pension income, retirement withdrawals in retirement? And yes, you heard that right. I said tax-exempt income. Your tax-exempt income could be factored into how much your Social Security is taxed. Now, the provisional income thresholds are different depending on your filing status, whether you're single, married filing jointly, or head of household. If you're single and you make less than $25,000 from those key components I mentioned, then none of your Social Security income is going to be taxable. If you're single and you make above 25 and below 34, then up to 50% of your Social Security income could be taxable. I'm not saying that it would be taxed at 50%. No, it would be taxed at the regular income tax brackets. I'm just saying 50% of what you received from Social Security could become part of your taxable base. Now, as a single filer, if you make more than $34,000, then up to 85% of your Social Security income could become taxable. Thankfully, there is an 85% cap after 34K. There's nothing above that, which means that you will never pay tax on at least the difference, which is about 15% of the taxable income. Now, for joint filers, the thresholds are a little bit different because there are two people factored, but it doesn't double the number. So if you make $32,000 or less while receiving Social Security benefits, then all of your Social Security benefits are tax-free as a married filing jointly couple. 32 to 44,000 of income, then about 50% of your Social Security income would be part of your taxable base. And then above 44,000 as a married filing jointly couple, 85% of your Social Security benefits will be taxable. You may have noticed that some of those thresholds I mentioned, 25,000, 32,000, 34,000, 44,000, they're super low. Super low. If you're receiving pension or retirement withdrawals, if you're trying to make somewhere between, $60,000 to $100,000 a year in retirement so that you could live comfortably, that means your Social Security is going to be taxed. And that sucks. What sucks the most about it and what frustrates so many people is that these numbers I just gave you, these thresholds, haven't changed since the 1980s. Guys, inflation, these numbers should have been adjusted for inflation many years ago by the IRS, and that's what's frustrated so many people is that they haven't. These thresholds should be much higher than they currently are so that more retirees wouldn't have to pay income on their Social Security income tax. Now, the Democrats did try in 2022 to raise these thresholds. The problem is every time they introduce a bill to raise these thresholds, they try to add something else in that the Republicans don't like. For example, in 2022, when they introduced new thresholds to make Social Security income not taxable below a larger threshold, they also added in taxing higher income earners, W-2 earners, more Social Security tax so that they could essentially offset the income. Instead of taxing the retirees, let's tax the people that are still working and making a significant amount of income. And the Republicans aren't a fan of taxing high income W-2 earners more money. Meanwhile, former President Donald Trump has actually made headlines saying that he doesn't want Social Security benefits to be taxed at all. And while this is a really hot topic now in this upcoming election, he hasn't exactly made it clear how he would achieve that. Ultimately, we have to understand that if the IRS, if the government is going to lose revenue dollars by taxing retirees, where are they going to fill that plug? Who is going to pay that tax? What's crazy about all of this is we're just talking about the federal tax implications of Social Security benefits. But did you know there are some states that also additionally tax Social Security benefits? And that's really why there's so many retirees that flock to no state income tax states to live in. Ultimately, if you are subject to taxation on your Social Security benefits, one of the best recommendations we make as CPAs is to elect for withholding on that payment, right? You can reach out to the Social Security office and ask them to withhold 7, 10, 20% of your Social Security pay. And this will ensure that you don't arrive at the end of the year with a really large tax bill. So working with a really great CPA to determine what's right for you, what's going to be taxable, what that looks like in retirement, even working with a financial advisor to plan that in the future if you're much younger and farther away from retirement is a great idea. But while you're at it, you definitely need to smash that like button. Follow us on YouTube, Instagram, LinkedIn, Facebook at Accounting to Scale. And until the next video, you know I'm your favorite CPA, Tiffany Gonzalez.